It's all fluff, honestly. We're here to bring you the facts. We're here to be authentic in the way that we look at these products. And that is, we're looking for the facts. What is it that is going to really contribute to the bottom line? And while a bonus is on paper growing this income benefit account, what matters is the final bottom line, and that's the guaranteed income. I keep alluding to that. And the other factor that goes into determining the overall guaranteed income would be the income benefit base amount. So whatever that's grown to on a guaranteed basis after the bonus and after the roll-up rate's been applied each year. The last factor that goes in is what's called the payout percentage, or the withdrawal rate, or the payout rate. They all refer to it as different things, but it's essentially a percentage of the total income benefit value. When you multiply those two numbers together, that'll equal the guaranteed payment. That payout rate or payout factor can be based on single life. It can also be based on joint life. Obviously, if it's joint life, it's going to be covering two lives, so it's going to pay a little bit less than the single life payout factor would. But that payout rate, nonetheless, is also guaranteed in the contract. So that's important to note. When you buy an annuity like this and you receive that policy in the mail, in that contract, when you go over it with your advisor, they should be showing you all of the terms and conditions, all of the account summary, as well as the income benefit rider page or specification page, which will show you the bonus, the roll-up rate, the annual fee for that rider, etc. And they should be showing you, last but not least, the payout schedule, which has all of the payout factors based on the age at the time of income election. So if it's for a single person, it would be the age of that single person that it's covering at the time of income election. Or if it's joint, there'll be a joint schedule, which will show the age of the younger of the two annuitants on the contract and what that payout rate will be for the younger of those two annuitants. So it's very important. What we do for our clients is I'll highlight those things in the contract before it's mailed. That way we know exactly what to look for. The other thing to note is that these income rider contracts, they're flexible. So even though you might be deferring it for 5 years or more, if your needs change and you need the income sooner, you can activate the income at any time. In most cases, either right out of the gate. Sometimes they'll have a 1-year waiting period. But either way, you can activate it at any time you see fit. Obviously, though, keeping in mind that the income may be a little less because you didn't defer it as long and it didn't get that extra roll-up rate that it would have gotten if you continued to defer it. Shifting back over to this account value side on the left. So that is your premium investment. Sometimes they do offer a bonus over there that's called a premium bonus. But in one case or another, either it's going to have a bonus or not. But where this account value and the purpose of it is really to be looked at as your liquidity account. So this is your walk away money. If at any point in time you have a change of heart and you decide to forego that income benefit and just want to cash out, you can do that. And the money that you'll receive will be whatever's in this account value column minus any surrender charges that may be incurred if you're still within that surrender period. The surrender periods in these contracts are generally 7 to 10 years. So if you're in that 7 or 10 year window, there will most likely be a surrender charge that's incurred on that full withdrawal in the event you decide to surrender. You do also have some liquidity during that surrender charge period in the event you need a little bit of money to come out for maybe an unexpected cost of some sort. In most of these contracts, you're going to be able to get at least 10% or sometimes more, depending on the product. But most of them are 10% free withdrawal per year to help service any type of liquidity needs that you may have. And then last but not least, this account value can also be represented by your death benefit. In the event that you pass away and there's still money left in this account value at any point in time, whatever's left in that account value will pass on to your designated beneficiaries in the contract. That's one of the biggest misconceptions of these types of annuities, is that if you pass away, the insurance company keeps your money. That's entirely false. That only occurs in one type of annuity structured in one particular way, but that is not this type of annuity. So this is your death benefit. And then last but not least, remember that this account value still has the ability to earn interest on a non-guaranteed basis according to the various index crediting strategies that you may be allocated to. So in a perfect scenario, in the right annuity with solid index crediting potential, that account value can sometimes grow over the deferral period, and most likely will in a lot of cases if you're working with the right annuity. And it can also sustain that account value by the indexed interest that's coming in that can offset the income distributions when they go out. So, think of it like a checking account. If you were to put money in a checking account and then take an annual withdrawal or a monthly withdrawal to service your income needs, the a balance of that checking account is going to reduce every time you take a withdrawal. In an annuity, it works the same way. When you take a withdrawal using the lifetime income rider, that withdrawal is deducted out of your account value. But since it has the ability to earn interest from the index crediting strategies, in a perfect scenario, you can find a good annuity with great index potential, and those index returns can help offset the distribution that you're taking through income. So in a perfect scenario, that account value can sustain itself longer so that you can have higher potential for a death benefit down the road. That was a lot that we covered there, Zach. Was there anything that I missed?
No, so just to wrap this up in a bow, and I realize my picture is freezing up here, so just there we go. Okay. So to wrap this up in a bow, account value starts at the premium that's put into the annuity. So if somebody allocates $100,000 to that premium, it's put into the annuity. From there, that account value has the ability to grow on a non-guaranteed basis based on that index performance. The account value also, we have the flexibility in which if we wanted to take out or needed to take out up to 10% per year, we've got the ability to do that. And it also has the ability to leave a death benefit if the account value has not been used up by the reduction of the income coming out of the account value.
That's correct.
Okay. So then we move over to the right side of that T chart again. That's the income benefit base. That's a totally separate calculation from the account value, and it grows at a guaranteed rate every year of deferral. The big key element here is that rider charge, that rider that we've put on this annuity, that rider does not come out of the lifetime income paycheck.
That's correct, yeah.
Okay, that rider charge is deducted from the account value, so it never impacts the paycheck I receive every month.
That's correct. And that's a good call out there, is that sometimes people think that whatever that lifetime income amount is, that they have to factor the cost of the rider. And so they think of that income quote as a gross payment, not a net payment. But in reality, it actually is a net payment. So whatever that income amount quote is, that's the net number. That's not anything you have to do anything other than receive that amount. The withdrawal charge, or the rider charge rather, is deducted from the account value. It is not deducted out of your income payment.
Awesome. Okay, cool. Well, hey, I know we wanted to talk through some scenarios and just some real life client scenarios that we've had come up. Do you want to hit on one of those right now, or anything else you want to cover before we get to that?
Before we get to that, I think we should talk about the fees and cost of an income rider. I think it's good for our audience to know, the general range that they should be considering and what those costs might look like. It's very simple too. It's really going to be very transparent. So one of the other, in my opinion, misconceptions of annuities is people say that they're highly feed. Again, if you've listened to previous episodes, that's only one type of annuity, which is a variable annuity, which can often have anywhere from 4 to 8 different fees tied to it. And those fees can range anywhere from 2 to 5% a year. But in this type of annuity, which is a fixed indexed annuity with a guaranteed lifetime income rider, the fees are very transparent, and it's really going to be in the range similar to what most people pay in a common 401k or IRA today. Those income rider fees are going to range anywhere from 75 basis points, so under 1%, to 1.3% on the high end, depending on the specific company and the specific product that we're looking at. I believe that on average, in general, most people are going to end up in the maybe 1.1% range with most of the popular income rider products. But when you compare the fees of those income riders to the general fees that most people pay, and most people don't even realize they're paying these fees in a 401k or an IRA. They're normally tied to the mutual fund, or they're tied to the ETF or whatever they might be invested in. But it's going to fall in line with those average fee ranges for those 401ks or IRAs. And oftentimes I'll also let people know that while the fees are relatively low or average compared to a 401k or IRA, really where the value is on the lifetime income rider is that you're getting a contractual guarantee of lifetime income. And there's no 401k or IRA on this planet that can offer you a contractual guarantee of lifetime income. There's no investment advisor, no offense to our investment advisor friends out there that build income plans without annuities, but they're going to charge you a fee. That fee is about 1.5% a year. And there's not an investment advisor on this earth that will write you up an income plan with a contractual guarantee of income for life. You can only get that through an annuity. So when you compare the cost of an annuity and what you're getting for that guaranteed lifetime income compared to the fees that you're charged in a general 401k, an IRA, or an investment advisor that's managing a portfolio and helping you source income from it, the fees are really, really fair, in my opinion.
Yeah, it's a great point. Great point. Awesome. Well, yeah, if you like,
sorry to interrupt. One more thing too, going back to that roll-up rate nomenclature. So there are different types of roll-up rates. That's something you need to be aware of.